The top 7 emotional biases that drain your trading account. Trading is not just about strategies, charts, and numbers. It's about mastering your mind. No matter how experienced a trader you are, the biggest threats to your success are often not external, but internal. That's right. Emotional biases can derail even the most carefully constructed plans and strategies. So, how can you unlock consistent success as a trader? By confronting and conquering the emotional pitfalls that cloud your judgment and empty your trading account. In today's video, we'll explore the top 7 emotional biases that every trader must defeat to protect their portfolio and achieve sustainable growth. Let's begin. Before we dive into specific biases, let's first define what we're up against. Emotional biases are irrational beliefs or distorted thinking patterns that influence your decision-making. And in the fast-paced, high-stakes world of trading, these biases can impair your ability to see the market clearly and act rationally. Think about it. Have you ever clung to a losing trade, hoping it would miraculously reverse? Or perhaps you've jumped into a trending stock simply because others were doing so. These behaviors stem from unconscious biases, not rational analysis. The good news is that recognizing these biases is the first step toward conquering them. In this video, I'll not only outline the most common emotional traps, but also provide actionable tips to help you avoid them. Let's start with one of the most dangerous biases, overconfidence. Overconfidence bias occurs when past successes inflate your belief in your abilities. You feel invincible, convinced that you've cracked the code to the market. While confidence is necessary in trading, overconfidence can blind you to risks. For example, let's say you've had a series of winning trades. You might feel tempted to increase your position sizes or take on trades outside your plan, believing you're on a roll. But remember, the market doesn't care how well you did last week or last month. To overcome overconfidence bias, stay grounded in your trading rules. Trust your strategy, but also respect the unpredictability of the market. No streak lasts forever, and every trade should be evaluated with a fresh, unbiased perspective. Next up is loss aversion bias, the tendency to fear losses more than we value equivalent gains. While the desire to avoid loss is perfectly natural, it often leads to irrational decisions, such as holding on to losing trades far longer than you should. Picture this. You enter a trade and the market moves against you. Instead of cutting your losses, you wait, hoping for a reversal. As the losses deepen, you hesitate to exit because you've already invested so much. This mindset can quickly drain your account. To combat loss aversion, accept that losses are part of the trading journey. Successful traders don't fear losses, they plan for them. Set clear stop-loss levels and stick to them, no matter how tempting it may be to hold on. Remember, protecting your capital is more important than taking emotional chances. Let's talk about confirmation bias, another common trap among traders. Confirmation bias occurs when you seek out information that supports your preconceived ideas while ignoring evidence that contradicts them. Here's an example. You decide on a stock you believe will perform well. Instead of objectively analyzing all available data, you focus on news articles, opinions, or charts that support your position. Meanwhile, you dismiss negative indicators that warn of potential trouble. This selective thinking prevents you from seeing the full picture and makes you prone to costly mistakes. To overcome confirmation bias, challenge yourself to look for evidence against your position. Ask, what would disprove this trade idea? This mindset not only broadens your perspective, but also sharpens your ability to evaluate opportunities. Recency bias is another sneaky culprit that often leads traders astray. This bias occurs when you place too much importance on recent events, assuming they will continue indefinitely. For instance, after witnessing a week-long bullish rally, you might believe that the trend will persist and hastily enter a trade. However, markets frequently shift, and basing decisions solely on recent data can blind you to larger trends or reversals. To avoid falling into the trap of recency bias, zoom out, analyze historical data and broader market trends alongside short-term movements. A single week or month does not define the market's long-term trajectory. Consistency comes from seeing the bigger picture, not chasing the latest hype. Have you ever fixated on a single piece of information, like a stock's price target or the latest breaking news, and allowed it to dictate your decisions? That's anchoring bias in action. Anchoring bias occurs when traders rely too heavily on the first piece of information they receive, even when new data becomes available. For example, You might anchor to a forecast predicting a stock will hit $100. Even as market conditions shift, you continue to base your decisions on that $100 target, ignoring more relevant information. To overcome anchoring bias, remember that the market is dynamic, not static. Be willing to adapt as new data emerges. Set your anchor not on arbitrary targets or outdated forecasts, but on current factual analysis. Flexibility is a strength, not a weakness. We've all heard the phrase, "the trend is your friend," but blindly following the herd without understanding why can be disastrous. Herding bias occurs when the fear of missing out, or FOMO, drives you to follow the crowd despite questionable logic. For example, you see that a particular stock is skyrocketing, and everyone around you seems to be riding the wave. Without proper analysis, you impulsively jump in, only to find yourself caught at the peak before a sharp correction. To combat herding bias, trust your strategy above all else. Remember, what works for others may not work for you. Trade based on your plan, not the noise of the crowd. FOMO is fleeting, but a solid, disciplined approach will serve you far better in the long run. Finally, let's discuss the sunk cost fallacy, the emotional urge to continue investing in a losing position because of the resources you've already committed. This bias is common across all areas of life, but it's particularly destructive in trading. Imagine you've bought a stock that has consistently underperformed. Instead of cutting your losses and moving on, you pour more money into the position, thinking, "I've already invested so much, I can't give up now." Unfortunately, this thinking often leads to even greater losses. To defeat the sunk cost fallacy, learn to separate emotions from your decision-making. Evaluate your trades based on current opportunities, not past investments. If a position no longer aligns with your strategy, don't hesitate to close it. Every trade should stand on its own merits. Your trading capital is precious. Don't let emotions dictate how it's used. Emotional biases are the silent saboteurs of trading success. Whether it's overconfidence, fear of loss, anchoring, or FOMO, these biases often feel uncontrollable. But here's the truth: you can overcome them. By building self-awareness and developing habits of discipline, you can rise above these mental pitfalls. Approach every trade with clarity, staying true to your strategy and trusting your process. The market will always be unpredictable, but mastering yourself is a surefire way to secure consistent results. As we wrap up, remember this: success in trading is not just about mastering the charts, it's about mastering your mind. So go forward equipped with the tools to identify and overcome these biases. Your trading account and your future success will thank you for it. If you found today's video helpful, please like, subscribe, and share it with someone who could benefit from these tips.